Welcome to Lesson 3, Mutual Funds and Dollar Cost Averaging. Our objectives are to understand the concept of a mutual fund and to calculate investment value over time using the dollar cost averaging strategy. This strategy uses your investment dollars to help you even out some of the fluctuations in the market. When you looked at stocks previously, you noticed that sometimes they were quite volatile and it didn't make sense to put in money and then take it out right away. One thing that we can do to kind of hedge our bets is use dollar cost averaging. It works by investing the same amount in a security at regular intervals. So every month, for example, or every quarter. We use this strategy most often when we purchase mutual funds. People will invest a certain amount each month. Dollar cost averaging will give you an advantage because it helps reduce the average price you pay. The one thing you have to understand with dollar cost averaging is it does help take away some of the risk, but it also takes away some of the growth. Before we look at some examples using dollar cost averaging, let's look at what is a mutual fund. This is a short 2-minute video that will introduce you to the concepts of mutual funds.
Let's say that this is you. Hi, you. And you've got a little bit of money that you'd like to invest. Hey, $100, not bad. You could take that money and invest it in a stock in one company. Like, I don't know, Bell. And who knows, it might work out great for you. Bell might make you some money. But there's a risk. You're only investing in really one company, one or two companies, because you don't have a huge amount of money. You could actually lose money if Bell doesn't do so well. So what's an alternative? Well, you could give your money to this guy. He's a portfolio manager for a mutual fund, and he knows money. And so maybe there's lots more people just like you. And they only have a little bit of money too, so they all decide to invest in the same mutual fund. Now Mr. Portfolio Manager has lots of money to work with. So he can spread out everybody's money into lots of different companies. And now that everybody's money is all spread out, there's not as much risk. And that's basically how a mutual fund works. Some of the advantages of a mutual fund are professional management. You get your money in the hands of a portfolio manager. Diversification. He's able to take all of your money and invest in far more companies than you could do on your own. Simple. It's really quick and easy to get set up in a mutual fund at any bank. And it's affordable. You don't need a lot of money to get started. Some of the disadvantages of mutual funds are professional management. Don't forget, people are human. You're putting your money in the hands of a quote-unquote professional, but they might make mistakes with your money. Your portfolio manager might spread your money to too many companies, too thin, and you won't get much return. And a lot of mutual funds have some hidden costs that they like to bury in jargon, so you have to be aware of that. And there's a little look at just what is a mutual fund.
Understand that a mutual fund is an easy way for someone to get into the stock market without putting all your eggs in one basket. Let's go ahead and look at an example using dollar cost averaging. Let's say you have $15,000 that you want to invest in Sprint. The date is January 1, 2000, and you have two options. You can invest all that money as a lump sum and then walk away and forget about it, or you can set up a dollar cost averaging plan and ease your way into this stock. You opt for the latter and decide to invest $1,250 each quarter for 3 years. So let's see what that looks like. Well, up here we have January 2000, the date that you received your inheritance, let's say, or you have your $15,000, and the price per share is $56.72. If you want to buy this stock, you would invest $15,000 into the shares that you would purchase. So let's see how many shares you would buy. So option 1, $15,000 invested on January 2000 means that you would buy 264.46 shares. We found that by taking the dollar amount that you're investing divided by how much it costs per share. And that's how we know we would buy $264.46 shares. Well, what's next? If you walked away and forgot about it, what would be the value of your account in October of 2002? Well, it would only be worth $3,078.31. And the way we found that is we took the number of shares, 264.46, and we multiplied it by the price per share. So on that date, if you were to sell all your shares, what you would get would be $11.64 per share is all. That's what the stock would be worth on that date. So that's a considerable loss right here. Let's look at our second option, the one that we plan to do. We'll invest $12.50 each quarter for 3 years. And that's what this table shows. $1,250 invested in January. And then if we divide, we get how many shares we purchase each time. So $12.50 divided by 56.72 got us 22.04 shares. And if we do that each quarter, all the way through October, we can find the number of shares that we purchase each quarter. Adding those up, we get a total of 746.21. That's how many shares we own after this time period. Then we can also find the average cost per share that we paid. The way we do that is we add all of these share prices together, and then we divide by how many we actually have. In this case, there are 11 different periods listed, and that's how we get our average cost per share. Notice how that evens out. It smooths out these highs and lows. Earlier, we were paying $56 per share, and then you can see down here, we actually paid $8 per share in July of 2002, and 11 and 14 here. So dollar cost averaging does just that. It averages out what we pay per share. It helps us because sometimes we're buying shares at a very high price, so we're not getting many shares, but then other times we're buying shares at a very low price, so we're buying a lot more shares. So let's look at our profit. Here's option 2. Our stock is going to be worth the 746.21 shares we own times the price on that day. So it's still the price on that day if we were to share. The difference is we have a lot more shares perhaps. So we would get $8,685.88. It's still a loss compared to the $15,000, but not nearly as big a loss as if we had paid $56.72 for all our shares initially. So it helped to mitigate some of that loss. One more thing to think about, because our average price per share that we paid was only $20.10, if our price were to go up to that, we would break even. In order for us to break even using our lump sum investments, the price would have to go way back up to $56.72 in order to break even. Now think about what would have happened if the price were to go back up to that and we had dollar cost averaged. Well, we would actually have a fairly large profit. If you read here, without dollar cost averaging, we would have broke even at 56.72 as I said, but with dollar cost averaging, we would have turned a profit of $27,326 when it would actually have gone back up to hit that price. Let's try an example together. In this example, we want to invest $1,200, and we want to look at what we would have if we invested all of it on day one or invested $100 each month. Now remember that with dollar cost averaging, we don't necessarily come out ahead, but it helps to mitigate some of the losses if we have extreme losses. Unfortunately, if we have extreme gains, paired with some days of lower stock prices, it does taper those down as well. Let's see what happens here. So let's see what happens if we invest $1,200 all on day one. Well, in order to do that, remember, we have to figure out how many shares that we would be purchasing. So we would take 1,200 divided by the cost per share, 21.13. Let's see how many shares that we purchased. Dividing those, I got 51.88 shares. That's how many I purchased if I invested the 1,200 all at once. Now, let's see what happens if I invest $100 every month for a year. Okay, here's what happens each month. The price per share goes up, sometimes it goes back down. It fluctuates quite a bit. But you can see that, unfortunately, on April of 2013 of this year, this was the lowest price of any of the other months. So in this case, it would have been better for me to invest the entire $1,200 right away and purchase as many shares as I can at such a low price. But who can predict? So to be safe, we did a dollar cost averaging and we only purchased 100 shares here, and then we continued on down to purchase 100 shares each month. Our next step then is to figure out how many shares that we actually purchased each month so that we can figure out the value of our account at the end of 1 year. So what I did is I set up a table in Word and I put my purchase price here, $100. And then I calculated my shares purchased. And the way I did that is I took my purchase price and I divided it by the cost per share to get the number of shares that I purchased each month. An easy way to do this would be to set up a table in Excel, create a formula, and then fill that formula down. It would hardly take any amount of time. Then what I did is I added up all my shares to get my total shares down here of 43.93. So as I said, you can see that we, by dollar cost averaging, have purchased less shares than what we would have purchased had we invested it all at once back in April. Compare 51 to 43. Then what I did is I calculated my average price per share that I paid. And the way we do that is, remember, add up all your share prices and divide by how many periods there were, 12, to get an average price per share of $25.22. That's what I paid on average. So for me to break even, the stock price would need to be around $25.22. Of course, in this example, I've rounded my shares, and I'm going to be off a little bit, but this will give me an approximation. Now let's figure out what my investment is now worth after a year. So I own 43.93 shares, and all I have to do is multiply by the price per share on that date, which is $25.96. When I do that, I get $1,140.42. So that's a little bit of a loss compared to the $1,200 that I started with. But again, remember, the important thing about dollar cost averaging is that it mitigates the highs and the lows. In this case, we lost a little bit of money, but if we were to keep our funds going for another year or two, or even 5 or 10 years, there's a very good chance that we will end up earning or growing our account much more than the capital we initially invested. That concludes our lesson on mutual funds and dollar cost averaging. So at this point, hopefully you understand how to use dollar cost averaging to calculate what your account will be worth at different times. Also, you should understand that a mutual fund consists of a variety of investments. So it's not just stocks, it could be stocks and bonds and other types of investments that help you to invest and be involved in the stock market without actually having to put all your funds into 1 or 2 stocks. And remember some of the advantages and disadvantages of a mutual fund.